Hello and welcome to this session. This is Professor Farhat. In this session, we will discuss the concept of materiality, specifically the concept of materiality in auditing. Now we learn about the concept of materiality in Accounting 101, Introductory Accounting and Intermediate Accounting. And what is materiality? Materiality, what we learn is something that is important. It influences the user of the financial statement. It's basically the same concept here, but we have to define it a little bit more, fine-tune what is materiality in a auditing concept. So let's take a look at the definition and dissect the definition itself. Auditing standard define materiality as the extent of the error, which is the magnitude of the error, that either individually or when combined with others, individually or in aggregate, could reasonably impact users' economic decision. So it's an error. What's the extent of the error, how large it is, whether that error is individually large enough or combined with others are large enough, and those errors can impact the users of the financial statement. Well, if the error does all of this, then it's considered material. And this concept of materiality is crucial because the auditor cannot look at everything. They have to determine this materiality. So this concept is crucial because it helps guide the auditor the scope of the audit, help determine the scope of the audit. How much work do we have to do? Now, I'm going to give you an analogy. Think of materiality as like a doctor assessing a patient's health. Maybe you're wondering, what does a doctor has to do with auditing? This is why I placed a picture there. It's basically we have to make a judgment. The doctor will have to prioritize health issues based on their significance, on their importance to the health of the user. The user is the patient themselves. So auditor the same way focuses on errors in financial statement that could have material effect on the decisions of the users. Think about if you go to a doctor. Well, if you have a bruises on your hand, they might look at that, or they might ignore this if you have a high cholesterol or if you cannot breathe. So those are material issues, and that's what the doctor will focus on. They're not going to waste time treating your bruises because they're not material in the context of your health situation. So materiality helps auditor concentrate on significant issues, ensuring accurate financial reporting. So that's the overall concept. Now what we're going to do, we're going to take this definition and break it down into three components. We're going to talk about the magnitude individually. What does it mean individually or when in aggregate combined? And we need to define a very important group, users of the financial statement. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Starting with the magnitude of misstatement, the size of the misstatement, the magnitude. What's the magnitude of it? Now bear in mind, the first thing I wanted to tell you that one size fits none. It means one size for one statement. It doesn't mean it's relevant or the same for another company, for one statement or one company. Starting with the magnitude of misstatement, and I want you to keep this in mind. One size fits none. The magnitude, the size of a misstatement for one company could be different from another company. Why? Many reasons. Industry, the size of the company, the size of their balance sheet, the size of the financial statement, the importance of the error in a particular context. So the magnitude, though, refers to the size or amount of the error, omission, or discrepancies in the financial statement. And where would these misstatements arise from? Well, they could be errors, simply mistakes. They could be intentional manipulation, which is financial fraud, or they could be misunderstanding or misapplication of accounting principle. This is where misstatements arise. How large, how important? Well, it depends on many factors. But the size, there is not one size that fits all. For example, consider a manufacturing company reporting its inventory at 1 million. While auditors find that inventory is 950 due to error. So there's a $50,000 difference and is evaluated against a finance. There's a $50,000 difference. Now, how important is that difference? Well, it's maybe evaluated against total assets, maybe against net income, because we want to know there's a $50,000 problem. It means assets are overreported by 50,000. Let's assume they have 2 billion in assets. Okay? And what's 1 million in inventory? I would say 1 million becomes practically immaterial. Or let's assume they have 5 million in net income. Maybe 50,000 is not as material if the cost of goods sold is misstated because inventory is misstated. So that's only by the size. Or it could be a problem if misstating inventory by 50,000 influences the current ratio. Remember, what's the current ratio? Current ratio is current assets divided by current liabilities. Now, if this misstatement makes the current ratio, for example, 2, which is that's what lenders want, and fixing this error makes this current ratio below 2, then it becomes important regardless of the total size of assets, total size of income, because the decision now, it's changing someone's decision if you did not fix this error. So the auditor analyzes its impact on key ratios and stakeholders' decision, which is not easy to do, ensuring accurate financial reporting. Simply put, we don't know what the size is. The size depends on the context. That's the first thing you need to know about materiality. 2, we talked about the error could be individually or in aggregate. Well, materiality can apply to individual misstatement or the cumulative effect of multiple misstatements. So you could have small misstatement, one small misstatement, second small misstatement, third small misstatement. So each one on their own, they're not material, they're not important. But when you combine them, then they are material. So you have to look at them individually as well as in aggregate. So an individual misstatement may be immaterial on its own, but when combined with others, could be material. Also, one single significant misstatement could be material even if it's alone. So let's assume the auditor finds error in a software company's revenue recognition, each ranging from 5,000 to 10,000. Each one of those mistakes is not an issue by themselves, but when combined together, they total 150. Now, 150 misstatement and revenue seems maybe could be material to the users of the financial statement. So auditor assess both individual error and taking the errors in aggregate, combine them all together. That's also quantitatively we can do this. I think that the most difficult thing for the auditor to do when setting materiality is thinking about the users of the financial statement, because the materiality takes into account the users of the financial statement. So materiality is assessed based on the potential impact on the economic decision of users of the financial statements. And why is that difficult? Well, that's difficult because think about the users of the financial statements. Who are the users? Well, you could have investors, you could have creditors, you could have regulators, you could have many other stakeholders, suppliers, customers, employees. All of those are users of the financial statement. They rely on financial information to make informed decision. Now, let's talk about investors just to kind of illustrate the concept. I don't want to talk about creditors, but you can take the creditors and think about the creditors or regulators. You could have different regulators. Think about investors just as a group by itself, and think about a company like Apple Computers. Apple Computers is a publicly traded company. Who would invest in this company? Basically anyone, a mom and pop, average investors, you and I have some money, we could invest in Apple. We are investors in Apple. You could have institutional investors with billions of dollars, like Vanguard, The Street, BlackRock. Those are institutional investors. You could have pension funds, also with billions of dollars invested. You could have traders in Apple stock, either day traders or swing traders. They buy and sell Apple stock on a regular basis. You might have potential buyers of the whole company, like somebody wants to buy the whole company. You could have others like the original owners and extended family of a particular company. Here we're using Apple, but it could be some other company. So you have a range wide of users. So how would the auditor know who am I? Who are my users? All these are my users. How would I know? How do I define what's material to any particular group? See how difficult it is. Well, guess what? Auditors are professionals. And guess what? We have to use professional judgment. So what is a professional judgment? Well, it means you have to take into account many factors based on your knowledge, experience, the industry, the financial statements, so on and so forth. So back to the picture of this doctor, and the doctors also make professional judgment. Professional judgment involves professional discretion. You make a decision, consider various factors, industry norms, regulatory requirements, the expectation of stakeholders. You have to take all of those into account, just like a doctor makes a professional decision about your health. So by applying the concept of materiality, auditor can focus their effort on significant issues, ensuring, once again, proper financial reporting to the users. However, bear in mind, we're going to have to put a number. I know it's a professional judgment, but that professional judgment will have to be translated. In part of the planning process, we will determine materiality in various steps. We're going to start by looking at materiality for the whole financial statements. Then we would look at different type of materiality, performance materiality. We would look at something called tolerable misstatement, so on and so forth. Let's take a look at this multiple choice question from farhatlectures.com. A company is undergoing an audit, and the auditor discovered that the company understated its liabilities by $50,000 and a total balance sheet side of $5 million. How should the auditor assess the materiality of this misstatement? Okay, we have to use our professional judgment, right? That's the answer, but let's see what we're giving here. Well, if the answer is use your professional judgment, that will definitely be the answer, right? But it's not going to be that easy. It could be that easy on the CPA exam, but let's see the answers here. It's material because any understatement of liabilities is significant. Well, understating liabilities is significant. It's not good, but not any. Not any. I will take A out because it means any is significant, then everything is important. That's not true. It is immaterial because $50,000 is a small percentage of total balance sheet. Well, that could be. I will keep B between A and B. I will keep B and I will take out A. C, it's material if it affects the debt to equity ratio significantly. Now notice the word here, significantly, in a significant way. Also, if it affects debt to equity ratio, because decision makers, people that look at the financial statements, they don't look at the numbers out of context. They look at the numbers in context. One of those contexts is using ratios to make decisions. So if this $50,000 influencing debt to equity ratios, and it's not only that, in the answer choice I told you, and C, I put the word significantly. Kind of, they have to tell you something that it's important. I would say between B and C, I will take out B, I'll keep C. I'll say I think C is the answer, but let's look at D. It's immaterial because liabilities are not a key focus of financial analysis. Yes, liabilities are a key. Everything is key focus to a degree. And of course, liabilities, when you have that is important because that determines your risk level. I would say D is an easy elimination. And as I predicted, C is the correct answer. Now be careful, don't get to B and choose B and move on. What should you do? You want to go to Farhat Lectures, look at additional MCQs similar to this one. I have hundreds, if not thousands of MCQs, including previously released AI CPA questions on my website. You want to take those, practice, invest in yourself. Good luck, study hard, and of course, stay safe.